It's a pleasure to be back here in Bismarck. I was last here in August of 2011 when you were recovering from the flood. Glad to see that things are a lot better now than they were then. The title of the speech is We Can Do Better. And at the end of 2013, many observers were concerned that the Great Recession of 2007 to 2009 had created a new downgraded baseline for U.S. labor markets. But as I'll show you, the U.S. experienced rapid improvement in labor market performance in 2014. There is no longer evidence that the American labor market is trapped in some kind of dismal new normal in the wake of the Great Recession. In the absence of such evidence, I believe that policymakers should strive to facilitate ongoing improvement in labor market outcomes until those outcomes more closely resemble those that prevailed before the Great Recession. Now, I use a series of charts to show that that process of improvement is likely to take some time. By some key metrics, the labor market improved more in 2014 than it had in almost 20 years. Yet, by these same metrics, we would need to see at least 3 more years like 2014 for labor market conditions to return to their 2006 levels. I make reference to 2006 because that was the last year before the beginning of the last full year before the beginning of the Great Recession. It follows that monetary policymakers should be extraordinarily patient about reducing the level of monetary accommodation. Now, this recommendation for extraordinary patience contrasts with the suggestion heard from others that the Federal Open Market Committee should begin to raise the target range for the Fed funds rate for short-term interbank lending relatively soon. In the latter portion of my talk, I'll discuss what I perceive to be the 2 main arguments supporting this alternative recommendation and why I don't find those arguments compelling. The key bottom line of this discussion is that I expect it will take several years for the FOMC to achieve both of its macroeconomic objectives, its price objectives and its employment objectives. In this sense, I don't perceive any tension between the 2 macroeconomic goals of the committee. Extraordinary patience will serve us well to achieve both of them. Now, I look forward to taking your questions at the end of my prepared remarks, and we have microphones set up to facilitate that. For me, those questions are a highlight of these speaking engagements. As I'll discuss, two-way communication between policymakers and citizens is a core function of the Federal Reserve System, and the reason why it's set up the way it is. And your questions are a key part, I think, of that two-way communication. The views that I express today are my own and not necessarily those of others in the Federal Reserve System, including my colleagues on the Federal Open Market Committee. Now, before I get into the economic details of my speech, I'm going to begin with some basics about the Federal Reserve System. So I'd like to tell people that the Fed is a uniquely American institution. What do I mean by that? Well, relative to its counterparts around the world, the U.S. Central Bank is highly decentralized. The Federal Reserve Bank of Minneapolis is one of 12 regional reserve banks that, along with the Board of Governors in Washington, D.C., make up the Federal Reserve System. Our bank serves as the headquarters for Federal Reserve operations in the 9th of the 12 Federal Reserve districts. And our district is pretty large. It includes Montana, North and South Dakota, Minnesota, northwestern Wisconsin, and the Upper Peninsula of Michigan. So 8 times per year, the Federal Open Market Committee, the FOMC, meets to set the path of monetary stimulus over the next 6 to 7 weeks. All 12 presidents of the various regional Federal Reserve banks, including me, and the governors of the Federal Reserve Board contribute to these deliberations. But the voting members of the committee change from year to year. The voting members of the committee itself consist only of the governors, the president of the Federal Reserve Bank of New York, and a rotating group of 4 other presidents. I'm not a voter this year. I was last year. In this way, the structure of the FOMC mirrors the structure of our government, because representatives from different regions of the country, the various presidents, have input into FOMC deliberations. So I think this decentralized system has many desirable attributes. I believe that one of the most important is that it facilitates two-way communication between the nation's central bank and the nation's citizens. We're engaging in one direction of that communication right now. As I tell you, the citizens of Bismarck, and Mandan, about key considerations regarding monetary policy. In the other direction, the Federal Reserve Bank of Minneapolis gathers valuable economic information from local contacts in a variety of ways. So in fact, later today, I'll be meeting with the Federal Reserve Bank of Minneapolis' Great Plains Advisory Council, which includes business and community leaders from North and South Dakota, to gather exactly this kind of information. So relatedly, a number of people in this room have served or are currently serving on the Minneapolis Fed's Board of Directors or on one of our advisory councils. The information we get from these individuals, the public service of these people, and their many contacts who they reach out to on a regular basis, help ensure that we have a deeper understanding of what's happening in the local economy. So we want to thank all of them for their service. But let me turn back then to the FOMC and the making of monetary policy. I mentioned the FOMC meets 8 times per year. At these meetings, we decide on an appropriate stance of monetary policy for the economy. Key question is, what are we trying to achieve by varying that stance for monetary policy? And the Congress has charged us with trying to achieve 2 goals: to promote max employment and to promote price stability. And the FOMC has interpreted that second goal of price stability to mean keeping inflation close to 2%. Okay, so that's the backdrop for monetary policy. It's made by the FOMC. The goals we're trying to achieve are to keep inflation close to 2% and to promote max employment. So with that in mind as our goals, let's turn now to performance. How has the FOMC performed with respect to its employment mandate over the past 8 years? And I'm choosing the past 8 years, as I mentioned earlier, because 2007 marked the beginning of the Great Recession, so 2006 is really the last year, full year before the recession started. So I'm going to look at the end from the end of 2006 through the end of 2014. That'll really be the focus of my presentation today for all the metrics I look at. Now, many metrics are used to measure labor market performance. I'm going to concentrate on what I see as the most basic of these metrics, which is the fraction of people over the age of 16 to begin with who have a job. So this is a chart that shows the fraction of people, it's called the employment population ratio. This is the fraction of individuals in the United States over the age of 16 who have a job. And the gray shaded area marks the beginning of, marks the time period that's dated as the Great Recession, from the end of 2007 through the middle of 2009. And you see that the employment population ratio is around 63%. The beginning of at the end of 2006, fairly steady through 2007. Then we hit the Great Recession, and we really start to see a very sharp fall in that. And from December 2006 from December 2009, more generally, that's what the blue line is showing you, is that focusing on that period. This is a period of relatively rapid deterioration in labor market performance. And so the fraction of the people who had, over the age of 16 who had a job, fell from over 63% to just over 58%. Now, I think it's really clear about what happened here. These people did not suddenly become disabled. They did not suddenly develop a love for playing video games. Rather, this was a large group of people with talents and skills who would have been employed in 2006, but were not being utilized by the U.S. economy 3 years later. In this sense, the 5 percentage point decline in the employment population ratio represents a dramatic and disturbing waste of America's most valuable resources, its people. So that's on the first 3 years that I wanted to show you, 2006, 2009. And now I'm going to move to the next 4 years, the end of 2009 through the end of 2013. Now, at the beginning of this period, 58.3% of the population over the age of 16 had a job. At the end of this 4-year period, 58.6% of the population over the age of 16 had a job. Basically, this, and you can just see the chart, the employee population ratio remained essentially unchanged for 4 years. Now, we want to be careful in terms of interpreting this as being a clear sign of stagnation in the labor market. I mean, the steadiness will make you think that. More and more, the baby boom birth cohort, born between 1946 and 1964, are reaching an age at which we would generally expect them to retire. Many think that it would be natural for this demographic force to exert downward pressure on what we would think of as being maximum employment. So just more and more of the people over the age of 16 are reaching retirement age, so the fraction of people who have a job in this group are naturally going to decline. It's not necessarily a sign of poor labor market performance. Now, one way to strip out, there's many ways to go about stripping out this demographic effect. One of the easiest is just to look at the behavior of the fraction of those aged 25 to 54 who have a job. So now we're going to take out the people that we might be concerned about reaching retirement age. Now, I think it's qualitatively quite similar. The fraction of those aged 25 to 54 fell rapidly from the end of 2006 to the end of 2009. Obviously, these numbers are larger because more people who are aged 25 to 54 have a job relative to the whole group of people over the age of 16. But you see a sharp fall. You do see, I would think you see more recovery here between the end of 2009 and the end of 2013. That's consistent with the idea that demographics are part of what's holding back the recovery in the earlier chart that I showed you. But at the same time, I don't think there was anything to get excited about. The pace of recovery over this 4-year period from the end of 2009 to the end of 2013 was sluggish at best. So these kinds of data, the two charts I've shown on employment from 16 and over and 25 to 54, had led more than a few observers to be concerned at the end of 2013 that the U.S. labor market was stuck in some kind of adverse new normal. Fortunately, we see in this next chart that 2014 demonstrated that this kind of pessimism was unwarranted. So this is a fraction of people over the age of 16 who have a job grew by 0.6 percentage points. Now this increase looks modest in the chart. And the reason it looks modest is because how much things fell from 2006 to 2009. So that's you're drawing charts, you always have to keep in mind why are things looking the way they are. The reason this increase looks small is because of the fact we had such a sharp fall from 2006 to 2009. This increase looks modest in the chart, but it's equivalent to about 1.4 million jobs being created over just population growth. It's more, I think more strikingly, it's tied for the largest December to December increase in 17 years. So this is basically about as good as we've done in a given calendar year over the last 17 years. We actually see more of an increase in those aged 25 to 54. The fraction of those people who had a job grew by 0.9 percentage points. And that was the largest calendar year increase in over a quarter century. Actually going back, I think, to 1987. So what's the point, what's the punchline I want to you to take away from all these charts? We just saw tremendous improvement in labor market outcomes in 2014. In the wake of this improvement, there's just no reason for us to be thinking about the Great Recession as leading to some kind of new normal with weak labor market outcomes. All right, so what does this mean for monetary policy? So as I mentioned earlier, the FOMC has been charged by Congress with making monetary policy so as to promote maximum employment. Now, I think, in my view, the performance of the labor market in 2014 has large consequences for how the FOMC should be thinking about this congressional mandate. As I showed you earlier, at the end of 2013, the fraction of the population over the age of 16 with a job had remained essentially unchanged for 4 years. It was plausible, although somewhat depressing, to think that labor market performance had been permanently degraded by the Great Recession of 2007 to 2009, the gray shaded area. Under this pessimistic new normal perspective, the FOMC could have been seen as being close to fulfilling its maximum employment mandate. But the data from 2014 completely blew up this possibility, whether you look at 16 plus or 25 to 54. Last year featured the largest improvement in labor market performance in many years. This kind of dramatic change is simply not consistent with an economy that's stuck in a post-recession new normal. The pessimists are wrong. And so the FOMC should be aiming to facilitate a continuation of the 2014 labor market improvement. So this brings up a natural question. How close are we then? How close is the FOMC to its maximum employment goal? At any point in time, there are large uncertainties about the answer to this question. About what the long-run level of employment in the economy is. The remarkable improvement we saw in 2014, though, I think is strong evidence against the hypothesis the Great Recession, our slow recovery has permanently damaged the U.S. labor force. Without clear signs of such damage, I believe that it's natural for the FOMC to treat the pre-recession year of 2006 as a key guidepost in formulating its maximum employment objectives. Okay, suppose we thought that. We think of 2006 as representing max employment. How long will it take for the U.S. to get back to max employment? So now what I want to show you is via some simple calculations that will need at least 3 more years as good as 2014. So this is a graph of the employment population ratio. I've shown you this before. This is a fraction of people age 16 and over who have a job. I've got these new years I'm going to use in a second from after 2014. Okay, so I've shown you this picture before. And what we see is we're still well below where we were 8 years ago. So if we're aiming at 2006 as a benchmark, we still have a long way, a big gap to fill. Well, what does that mean in a time dimension? Suppose the next 6 years were as good as 2014. The employment population ratio in December 2020 would still be below that we had in 2006. Okay? So we have 6 more years as good as 2014, which is as good a year as we had in the last 17 years. And we would still be below the 2006 benchmark. With that, we have to be cautious, though. Because I mentioned earlier why we have to be cautious about using this as as being determinative. The aging of the baby boom birth cohort will put some downward pressure on this employment population ratio, make it natural for us to be below in 2020, for us to be below where we were in 2006. So to try to ameliorate that issue, the next chart does the same kind of picture, but now with the employment population ratio for age 25 to 54. So the blue line is what I've shown you before: sharp fall, gradual, very sluggish recovery up till 2013, then a very fast recovery in 2014. But now suppose we improved, and by this metric, if you remember, this was better than we've done in the past any calendar year in the past 25 years. Now suppose we had 4 more years in a row like 2014. So 2015, 2016, 2017, and 2018 were all as good as 2014. Then the fraction of those age 25 to 54 with a job would be slightly above where we were in early 2007. So what do we conclude from these kinds of pictures? I've suggested that given the absence of clear evidence of post-recession damage, the strong labor market conditions that we had in the United States in 2006 are a natural benchmark characterization for the FOMC's goal of maximum employment. Under this perspective, if you adopt this perspective, the committee needs to make policy choices that will lead to more great years like 2014. Not 1 more year like 2014, not 2 more years like 2014, but at least 3 more years like 2014. My own assessment is that the committee will only be able to achieve this outcome by being extraordinarily patient about reducing the level of monetary accommodation. In particular, I don't see raising the Fed funds target range for the Fed funds rate above its current low level in this calendar year, in 2015, as being consistent with the pursuit of the kind of labor market outcomes that we're charged with delivering. Okay, so that's the main. I would say the main message I want to be delivering is that To get back to where we should be aiming for, it's going to take some time, at least 3 more years, and that's not consistent with raising the target range for the Fed funds rate in this calendar year. Now I want to switch to talking about the counter case. More than a few observers have suggested that the FOMC should raise its target range for the Fed funds rate soon, possibly as soon as June. So here we are in April. So some observers suggest we should be raising the target range for the Fed funds rate in 2 months. I now want to turn to what I see as the 2 main arguments underlying this alternative perspective and explain why I don't find them compelling. So I've talked a lot about maximum employment. Let me switch now to talking about price stability. The FOMC is also charged with a second goal of promoting price stability. And accommodative monetary policy, keeping interest rates low, pushes upward on prices. So in principle, keeping policy sufficiently accommodative to achieve maximum employment could lead inflation to be too high. And along those lines, some observers have suggested that it's necessary to raise the target range for the Fed funds rate soon in order to keep inflation under control. Now, I think this suggestion is theoretically plausible, but it seems sharply at odds with the actual behavior of inflation data. So the FOMC has translated price stability, as I mentioned earlier, to mean a personal consumption expenditure inflation rate, PC inflation rate, of 2%. Here's what inflation has looked like over the past 7 years through the end of 2014. It moves around a lot. Most of these big movements are due to something you're all too familiar with here, oil prices, moving the price of gasoline around. The average rate of inflation, though, over this whole period has been 1.4%. Remembering our target is 2. So the average over this past 7 years has been 2%. It's at the end of 2014, it was 0.8%. That's what we have here. Actually, we come into 2015, it's falling even further because, again, downward pressure from gasoline prices. It's been below 2% for nearly 3 years. This is all backward looking, though. And it's generally thought, as monetary policymakers, that our policy choices affect prices and employment with a lag of about 18 to 24 months. So we need to base our decisions on our forecast for inflation over that kind of horizon, 18 to 24 months out. Now, my own expectation is that the inflation rate will be below 2% until 2018. Inflation is a variable that typically evolves very slowly. It's been below 2% for a long time. It's unlikely to move back, and so it's unlikely to move back to 2% rapidly. Now, to be clear, as we saw in 2011, basically most of this chart is below 2%, except for in 2011 when we came above 3%, and came close to 3%. Changes in oil prices, and that's what was driving that then, could lead inflation to blip above 2% for a few months. But I don't see inflation returning to 2% in a sustained way for 3 years, and possibly longer. My perspective mirrors that of Federal Reserve Board staff. So the minutes from the January FOMC meeting specifically state that the staff outlook is that inflation will remain below 2% through the calendar year 2017. Now, why do others see stronger inflationary pressures? I believe that they're implicitly or explicitly basing their assessments on an economic relationship that's called the Phillips curve. And the basic idea of the Phillips curve is as the unemployment rate falls, the growing scarcity of workers should push up on wages and prices. And so the unemployment rate has been falling steadily over the past few years, and it's thought by some that this decline should generate 2% inflation in the next year or two. I agree, and to be clear, I agree these basic forces are at work in the labor market. I mean, scarcity will generate wage pressures, and that should at some point translate to price pressures. The problem is that for a number of reasons that we don't fully understand, the Phillips curve moves around a lot over time. And this really makes it hard for policymakers to rely heavily on the Phillips curve in practice. So the current unemployment rate is 5.5%, but it's hard to translate that into a useful estimate of future inflation. There's been a lot of research on inflation dynamics over the past 15 years, and I would say the main takeaway from that research is, except possibly during the initial onset of recessions, you see the very sharp downward movement in inflation there, forecasters should put relatively little weight on the Phillips curve and formulating their predictions about the future course of inflation. So that lesson informs my own inflation predictions, where I'm putting, it's not that I put zero weight, but I put relatively little weight on the unemployment rate in thinking about where the inflation rate is going to evolve in the future. To sum up, the FOMC is charged with making monetary policies to make two goals: promote price stability and promote maximum employment. There is no tension between these two objectives at the current time. It will take several years for employment to get back to its maximal level. It will take several years for inflation to return to target. So we can best facilitate the pursuit of both our mandates by foregoing any near-term reduction in the level of monetary accommodation, such as raising the target range for the Fed funds rate soon. So I now turn to the second factor that leads observers to favor raising rates soon, which is financial stability. And there are two distinct concerns about financial stability. The first is that excessive risk-taking in the financial sector could make the macroeconomy more susceptible to adverse shocks. And it's thought by some that raising rates could modulate this kind of behavior and these kinds of vulnerabilities. The good news is that the Federal Reserve staff carefully monitors the financial system for exactly these kinds of vulnerabilities, doing a lot more in this dimension than we did 8 years ago. I see little evidence in their analysis to suggest that a monetary policymaker should see financial stability risks as being in any way material. Capital and liquidity are high in the banking sector. Maturity transformation remains modest. The level of borrowing among households and non-financial firms remains low. The second concern is more about a vulnerability to monetary policy. The financial system may be vulnerable to an unduly rapid increase in interest rates. So if the FOMC would raise rates too fast, that could create problems in the financial system. So to forestall this risk, some observers recommended the FOMC should begin to raise rates soon, so that the path of interest rate increases can be very gradual. And that would help ameliorate this risk of a rapid increase. Now, my own perspective is, given the pictures I've shown you in terms of employment and inflation, the FOMC can be both late and slow in reducing the level of monetary accommodation. To be more specific, based on my current assessment of the future evolution of the economy, I anticipate that it will be appropriate for the FOMC to defer the initial interest rate increase until the second half of 2016. It's 2016. It would then be appropriate, under my outlook, for the FOMC to raise the target range for the Fed funds rate thereafter to about 2 percentage points by the end of 2017. This would be slower than the last tightening of monetary policy in 2004 to 2006. So in 2004 to 2006, which was the last tightening cycle, so to speak, in monetary policy, essentially the committee was raising interest rates at about 2 percentage points per year. My proposed outlook would be to start late, latter half of 2016, and raise even more slowly than we did in that 2004 to 2006 period. Let me conclude, and then I'm looking forward to your questions. I'm an economist, and economics is often, with very good reason, called the dismal science. But my message to you today is one of hope and optimism. From 2006 to 2009, we saw a marked deterioration in labor market performance. As recently as a year ago, it seemed like this loss of human resources might prove to be permanent for the U.S. economy. But the rapid growth in employment that we saw in 2014 shattered this hypothesis. The lesson of 2014 is clear. We can do better. The FOMC is charged with promoting maximum employment. In the wake of 2014, I see no reason why the committee should not aim to facilitate continued improvement in labor market conditions. Indeed, I see no reason why we should not aim for the kind of strong labor market conditions that existed in the United States at the end of 2006. We can only get there if we make the right choices. The FOMC can only achieve its congressionally mandated goals of prices and employment by being extraordinarily patient in reducing the level of monetary accommodation. So under my current outlook for the economy, I continue to believe that it would be a mistake to raise the target range for the Fed funds rate in 2015. Thank you very much for listening. As I say, I look forward to taking your questions.